Hi, everybody. Today we have another great podcast for you in the SMB space. We have Josh Siegel on from Albrecht Law. Josh, great to have you.
Yeah, thanks, Dennis. Very happy to be here. Looking forward to the conversation.
Yeah, it's great to have you. And for those that don't know, Albrecht Law, they're a law firm that works on M&A representation and also tax structuring and diligence for buyers and sellers. They work with both independent sponsors and also searchers in the SMB space. And for Josh, his background's really on transaction tax. Prior to this, he worked as a director of transaction tax at Baker Tilly and was also a senior manager in M&A at Deloitte, and before that at PwC. So a lot of tax in Josh's background, but specifically on tax structuring for M&A deals. So buy side and sell side due diligence for an acquisition, and also optimizing your tax, post transaction. So to start, Josh, I think for our viewers out there, could you just go through, if I'm a SMB searcher, I might have done a Q of E and some accounting work, but what is sort of the tax planning side of it that is often overlooked in this space?
Sure. So I think, there's obviously the financial side of the transaction, incredibly important to nail down in the business strategy. But I would say tax, it's really can't be involved early enough, even from the pre-LOI stage. Having the right tax structure in the LOI, really sets a deal up. To have no surprises further on down the line. If an LOI is silent with tax structuring, the buyer may be thinking asset sale, the seller may be thinking stock sale, and it can become a huge wrench in a deal down the line. So, from a tax structuring perspective, getting that right early on and communicating clearly to the other side of the deal, what the expectations are and how you're valuing the deal is incredibly important. Um, so from an M&A tax perspective, we get involved, as you said, with tax diligence, which is a bit unique to myself. I'm a CPA as well as a tax attorney, and having worked at Big Four and national CPA firms in the past, I have a heavy background in tax due diligence. Now, obviously, we do the drafting and the review of all the legal docs from a tax perspective, as well as get into the details in preparing tax structure plans and the slide decks that go along with them. And then also, research and writing projects, opinions. I've done private letter rulings on different tax issues, and something that comes up often in conjunction with the structuring is qualified small business stock, QSBS, or Section 1202. So I've done a lot of legal memos and or opinions to understand whether or not the stock of the company would qualify.
And we're going to get into a lot of that today. I think to start, you touched on it briefly, but if I'm submitting an LOI, what is an asset purchase and what is a stock purchase? And what are kind of maybe the main three things I should think about there going into the LOI stage if I'm new to the search world?
Sure. So I'll start with a stock purchase. So if you're the buyer and you're submitting an LOI and it's a stock purchase, all of your purchase price and all of your basis, which is, your cost basis, is going into the stock of the legal entity that you're buying. And we'll assume for this purpose, we're talking about a C corporation. So if you buy the stock of a C corporation for $1 million, you'll have $1 million of basis in the C corp stock. Now, you can't amortize or depreciate that, and you don't get a step up in basis in the assets inside of the C corp. So any built-in gain that can is sort of being kicked down the road. You just continue the depreciation amortization of whatever basis exists inside the C corp when you buy it. That's not the ideal structure from a buyer perspective, because you're not getting the economic benefit currently of depreciation amortization based on the purchase price you're paying. If you're buying the stock of an S corp, it's a little bit different. You still don't get any depreciation amortization, but having basis in the shares of the S corp, it's not quite as, I'll say, worthless as the having your basis trapped in shares of a C corp. Now, obviously, upon sale, of those same C Corp shares, you will get to utilize the basis, and your gain would be whatever you sell it for, less your basis in the shares, but you don't get any immediate economic benefit. So then now looking at it from an asset purchase, and again, there's a literal asset purchase where you're buying each of the assets in the legal agreement. Then there's some synthetic asset purchases, I'll call it. Either there's a 338H10 election, there's a 336E election, and the use of either of those elections will depend on the facts of the transaction. What type of legal entity the buyer is, the seller structure, but those are options. And then also there's what's called an F-reorganization, which we can go into a bit more in detail, maybe on a separate question. But essentially, those are three options to take to get a synthetic um, asset purchase where you're buying the equity of a legal entity, but you're getting asset purchase treatment for tax purposes. And again, why asset purchase treatment is important for tax purposes from a buyer perspective is you're getting the step up in basis in each of the assets that you're acquiring. So the tax code sets forth 7 classes of assets. You basically waterfall your purchase price down those classes of assets, based on the final balance sheet and potentially some adjustments depending on the deal. And then you're getting to depreciate or amortize the entire purchase price between 1 and 15 years. So intangibles, goodwill, sort of the excess purchase price over the identifiable assets will go to either intangibles or goodwill, and you amortize that over 15 years. So again, you can take the present value of the future amortization and depreciation, and that is the financial benefit to the buyer of doing an asset purchase versus the same deal as a stock purchase. And taking that into account, I mean, that can truly affect the value that a buyer is willing to pay in an asset deal versus a stock deal.
Yeah,
So
let's
I know I said a
maybe
lot.
no, it's very helpful for a lot of folks. I think let's put it into stone here with more of an example. I think let's say I was buying a very equipment heavy company with a fleet of trucks, right?
Mm,
Just from a high level numbers perspective, from the asset perspective and the stock perspective, how should I think through maybe what I'd owe in terms of tax on those two, whether it was a stock or an asset purchase?
sure. So just say you spend $1 million, right? And one's a C Corp and the trucks are inside the C Corp. They're already fully depreciated, right? So you're not getting the depreciation on the $1 million. So there may be loans or maybe other deductions, right? You have your natural costs of running a business, but you're not getting that, I'll call it a tax shield from the depreciation. So, if you're, I don't know, just say, you're making $1 million and, you're not getting depreciation on the million. And I'm guessing trucks would probably be 3-year class asset. And so, essentially you get a third of that million each of the first 3 years. So that is the, you know, the benefit you're losing versus, okay, now you buy the trucks, you do an F-Reorg, you make one of the elections I spoke about, and you're treated as buying the assets. Now you get to step up the basis in those trucks to $1 million collectively, and now you get to depreciate that, and so that is a significant shield against taxes for the depreciable life of those assets.
Thank you. Yeah, and I think there, for folks out there thinking through this, what's the breakdown you would say from your perspective? You guys see a ton of deals in market between asset and stock purchase agreements when folks are going to the table for a deal. Is it split? Is there a trend? What have you kind of seen in the market for folks that are making negotiations?
Yeah, so it really depends on the legal entity type of the seller. If there's a C Corp seller, it's very hard. So I'll just stick with a simple example, like one standalone C Corp. If you're buying a C Corp out of a public, if it's a carve out where you're buying a C Corp out of a consolidated group, or it's a publicly traded company and you're buying, one entity out of that, that's a different scenario, but that's not the general scenario in the independent searcher and, you know, um, in independent sponsor space. So yeah, with assuming we're talking of a standalone C Corp, the economics just don't work out in the buyer's favor to do an asset sale out of a C Corp. Now, I've seen it happen, but I would say generally it's that the seller, either doesn't have advisors or has advisors that, you know, haven't thought through the tax consequences. But when you buy assets out of a C corporation, that built-in gain. So this, just say the $1 million purchase price less the basis, and usually they're already pretty fully depreciated unless they just bought a lot of new equipment in the prior year or two. So you're paying 21%, you're paying the corporate level tax on that gain. Now you pay the tax, and then that has to get distributed up to the shareholder, right? For them to realize their gain on the sale at the outside the corporation. And so then that's treated as a dividend to the extent of E&P, which is, you know, this is all tax nuance, but like generally treated as a dividend. So again, which is taxed at capital gains rates. So you're paying another 21% tax or so, and that's just federal. Obviously, we have to consider state in that, depending on where they are in the country. Um, but that's inefficient, right? Where you're paying two levels of tax, and so the buyer is, or the seller is generally going to ask the buyer for a gross up, right? If they just sold the stock, one level of tax, right? Long-term capital gains, assuming they've held it for longer than a year at the shareholder level. So now they're incurring this whole separate additional layer of tax so you can get a step up in basis. So they're generally going to ask for a gross up equal to that 21% tax. Okay. But it would be fine, it would be neutral if the buyer could get full depreciation in year one, right? You're paying the 21% tax, you're getting the 21% tax shield, except as we spoke about before, the asset lives are between 1 and 15 years. So if a lot of it's going to goodwill and you're depreciating a lot of that $1 million over 15 years, you take the present value. There's no way that the buyer is going to win that if the seller wants a gross up. So if it's a standalone C corp, it's quite hard to make the economics work other than just a stock sale. Um, and you see plenty of deals, if it's a very good target quality, the high quality of earnings, and it's a growing market, it's a very attractive deal. Deals do get done with buying C Corp stock. However, in the lower middle market to, you know, lower market space, there are a lot of S corps, there are a lot of LLCs, and with those targets, it's much easier and more efficient from a tax perspective to structure it as an asset sale, asset purchase, and so that's generally where we end up.
No, thank you for that overview. And that's important for folks to think about too as they go through the process. There's a lot of implications whether you choose an asset purchase or a stock purchase in terms of price with that gross up once you talk to that seller, right? So even if you are down the path of starting your deal under an asset or a stock agreement, that might change as you get closer to close. And the seller's advisors say, hey, did you know, there's this big tax bill coming down the line? And, expect some adjustments, right? I think that probably happens to you guys quite a bit during a deal.
Yeah, there's some deals that we've, clients have changed counsel. We've kind of come in, still towards the beginning, but not at the very beginning. And then we bring up like, hey, especially if we're working on the sell side, did you think about a gross up? Here's why it's reasonable to ask. Here's what you should be asking. Here's how to communicate it. And then they really start to dig in at, what's my after tax cash going to look like? I mean, I would say from a seller's perspective, that's one of the most important things you can understand, even at the LOI, even maybe before you accept an LOI, is like, what is my after tax cash going to look like? I mean, I worked on a deal once where the sale price, I think, was around $60 million. and there was some international issue. It was more complex. It was a bigger business, but um, once the seller got down to what his after-tax cash looked like, um, he started to question. He made a lot of money each year. Threw off a lot of nice cash to him. He's like, can I make this work for the next 20 or 30 years of my life if I live a long time? And so I think as a seller, it's very important to consider is like you're literally replacing all your earnings, and like this is your kind of lump sum nest egg for the rest of your life, assuming you're not going to go, if you're a serial entrepreneur, maybe that's a different story. But it's very important to understand after tax what you're taking home out of the deal. And I think the sooner the seller realizes that, the less likely that is to blow something up, a month from close or a couple of weeks from close. You've already spent all these deal fees, all this diligence. Then the seller kind of comes to a realization that, hey, maybe I can't live on this forever. And that really changed the tone of deals. And I've seen it happen way too late in the game. Um, so I think that's important for the seller to know up front.
Come on, it's never too late in a deal to change everything around. But no, it's definitely part of the process for those folks planning. And I think if you could give folks an idea, what steps can the buyers take early on in their search to avoid any kind of surprises down the line? Obviously, you mentioned a few, but if you had, maybe your top three or five categories that you see issues with, where can note to these folks, this is something you should look for up front as you're going through the process.
Yeah, just again, like understanding, like obviously I think about it from a tax perspective, but understanding, who the seller's advisors are. I mean, you can see this all day long on X, Twitter, whatever. From a general M&A perspective, when you're working with legal counsel on the other side of a deal that isn't an M&A focused attorney. They have deal experience or a business attorney, but I would say there's just sort of an M&A language. You can say, hey, we're thinking of an F-Reorg. They're like, okay, great. That, people already know what's reasonable given certain fact patterns. So I think just understanding who the seller's advisors are, or the other side, if you're the seller, who the buyer's advisors are, and just understanding, is it going to move mountains to get to market, right? Do they understand what market is? I think that has a big influence on the fluidity of a deal. So specifically for tax, like, do they have tax advisors? Are they going to, talk to them now? Are they waiting to the last second? Again, waiting to the last second is no good for anybody because, the seller might be shocked after tax. They're not taking home, this big headline number. So I think that's important. Um, it's important to communicate very clearly up front in the LOI, as the buyer, like, hey, we're valuing this as an asset purchase. We intend to do an F-Reorg. We intend to make this election. And then from a buyer's perspective, working with your advisors, understanding, what elections are available. And again, that just depends on the facts of the legal entities involved, what the buyer structure looks like, what the seller structure looks like. And so just being very clear and intentional about these things sets up a much smoother runway and path to getting a deal closed and not having tax, be a hang up. Look, there's so many things out there that can end up, being a hang up in a deal. And so I try to make tax like, you know, not get to that point.
And that's why everyone should go to Josh with all their questions, because it's definitely something that comes up in the process. And I think there, you did touch on quite a few of them, but could you just go through sort of the major elections maybe I should be aware of? Obviously, there's a lot that goes into behind the scenes actually executing, but walk folks through, an F reorg, a 338, maybe some of the main elections that are out there to consider, because
Sure.
while it might not be their job to understand this fully, it's definitely, on them to sort of lightly dig in to understand, as you pointed out, to put that in the LOI up front as much as they can and talk about it up front as much as they can and get ahead of any problems down the road.
Sure, sure. So uh, the first election that kind of came into the code was the 338H10 election. And again, that election, making that election, you're buying stock of either a C or an S corp, and you're making this election. And so for tax purposes, you're treated as buying assets. But from a legal perspective, a lot of times it's much easier to buy stock versus retitling, tons of assets and, going through bulk sale in certain states and things like that. Um, with a 338H10 election, the target either has to be a C Corp coming out of a consolidated group. It doesn't work for a standalone C Corp, or it can be for an S Corp target. And the buyer in a 338H10 election has to be a C Corp. So not an LLC, not an individual. So there's some restrictions in a 338H10 that, given the modern business landscape of a lot of LLCs and a lot of standalone C corps, it just Congress then put into place a 336E election, which has similar. It has slightly different defined terms, but ultimately generally the same requirements. And for either a 338H10 or a 336E, you have to buy at least 80% of the stock within a 1 year period for it to be. I think it's a qualified stock purchase in a 338H10, and it's a qualified stock disposition is the defined term in a 336E. So again, same headline requirements, but in terms of how much stock you have to buy for it to qualify. So if you're only buying 70% or even 79, like those elections won't work. And then a 336E they put into place to really open it up to more buyers. You can be an LLC, you don't have to be a C Corp buyer. So again, it just depends on what the buyer's legal entity structure looks like, what type of legal entity the seller is, whether or not these elections are feasible and can work. And I would say, regardless if those elections work, you have to think about a successor liability standpoint, because yeah, you're getting a step up in basis in the assets, but you're buying the legal entity. And when you're buying the legal entity, that is the most, again, it's potential risk, right? If but you're taking on the most potential risk buying the legal entity. You're taking, from a tax perspective and successor liability, if you buy the legal entity, you have successor liability for income taxes, non-income taxes, really the whole gamut of taxes, versus if it's structured as an F-Reorg or a literal asset purchase, you're generally leaving behind any historical income taxes. Now, buying assets, you still have successor liability for non-income taxes, thinking sales and use tax, gross receipts tax, local tax stuff, generally payroll tax still transfers. But again, from a successor liability standpoint, it's more beneficial to not buy legal entity, and so the historical legal entity. And so that's where like an F-Reorg comes in, and you can really try to marry the best of both worlds. So an F-Reorg comes
Let's
about.
dive in more on an F-Reorg specifically, because it's definitely one they should know. But how does that, affect their tax situation post acquisition?
Either an asset sale or an F-Reorg. So the end state of an F-Reorg, you're buying a disregarded LLC. And so when you buy a disregarded LLC, you're treated as buying assets. So again, they're getting the step up in basis similar as if they made an election or just literally bought assets. The big difference between an F-Reorg and buying a disregarded entity at the end state of the F-Reorg versus making one of the two elections we spoke about is successor liability. So to set up an F-Reorg, the seller would generally be an S Corp. They create new co S Corp. They contribute old co S Corp below. They make a Q sub election, and then the following day, or at least one day after the Q sub election, they're converting that to an LLC. That converted LLC retains its original EIN. So for a lot of deals, it's like, you don't want to change the EIN because you have to change all the contracts and the banks. And, so an F-Reorg allows you to keep the EIN and allows you to get asset purchase. And because the seller sets up this new co S Corp that's considered a continuation of the old S corp, you're leaving behind all of the successor liability with regard to income tax that I had talked about before. And so you're just inheriting any liabilities with regard to, generally think about it as non-income taxes.
No, thank you. It's definitely an important point for folks to dig into more. So we'll make sure to cut a few shorter clips of this stuff because it is a lot to take in, but it's definitely
Yeah.
important to
Sorry.
think through.
I don't mean to talk
Um,
like on and
no,
on.
this is exactly why we're doing this session. But for those out there who do want to use your firm and work with you guys, what's the best time to contact you if I was a searcher? Is it post LOI? How close to close? How long essentially does it take to do some of these elections?
Sure. So, elections or setting up the F-Reorg, which is, a bit of structuring and depending on, again, the advisors on the other side, sometimes it's helpful to put it together in a PowerPoint structure deck, walking everyone through step by step and the tax consequences, get everyone on the same page and very comfortable that it's going to work. I would say, the sooner the better. Really, as I said, I think one of the most important things from a tax perspective for having a fluid deal process and not having the structure cause any hangups or any miscommunication is really getting involved pre-LOI. And so at Albrecht Law, we actually have a specific engagement pre-LOI where we charge a flat fee, and I think it's on the reasonable side, and basically we have our template LOI that we've created from Ellie's amazing experience at Gibson Dunn and DLA and the great law firms that he's worked for, and myself, and we have a form we really like to use, but we're happy to use the buyer's form if they have something they love. But it's a really comprehensive review from a legal and from a tax standpoint, ensuring that everything is clearly communicated. Hey, we talk to them. Here's once they tell us what the legal entity that they're trying to buy, the legal entity structure, we walk through, here's the options. We'll walk through these elections. We'll walk through the F-Reorg. Whatever is available, we'll say, here's all the options on the table. Here's the benefits. Here's the drawbacks. And what sounds best for you from a business perspective, because it really should be the business driving the decision. And then based on what your business goals, are you looking to flip it quickly? Are you looking to hold it? Is this the first platform deal and you're going to tuck a lot of things underneath? Does this going to throw off a lot of cash? Is your idea to have higher income currently or to build it and really have an asset to sell later on? So that can influence, do we want to have a C Corp Holdco? Do we want to have a flow through? And those are all things we want to consider in the LOI phase, because it really does affect and what we communicate and how we communicate. And I think that just sets it up for having a clear LOI that's more likely to get accepted. And post LOI, post signing, no change coming from the buy side, right? Like, hey, well, we thought you said this in LOI, now you want to change it. And then the seller comes back with 20 changes they want to make, right? And it's not a productive conversation to have post LOI. So I would say pre LOI is ideal.
Okay, great. And then to finish up here on this sort of technical session, there was questions that we have received about QSBS. It's definitely
Hmm.
something I am more familiar with. The venture side talks about quite a bit. On the searcher side, I think folks are becoming more aware. But for QSBS, what qualifies and what doesn't for folks, and how should they think about that in terms of as they approach a buyer or seller rather?
Yeah. So, QSBS, again, it's more complex, and I'm not going to do it full justice. So I want to caveat that this is all at a very high level, and there's more complexities to dive into on a deal by deal specific basis. But generally, the requirement, well, let me talk about quickly the benefits of QSBS for anyone who isn't familiar. I mean, the headline benefit is you can pay zero tax, so you can exclude 100% of tax, um, up to $10 million or 10 times your basis in the share. So if you invested $10 million, you could potentially exclude up to $100 million, pay 0% tax, and that's at the federal level. I'll say most states conform to federal. I know California does not. So if you are a seller who lives in California, you could still be stuck paying state income tax. But on a federal level, no matter where you live, is 0% tax, and it's the greater of 10 million or 10 times essentially your investment in the shares. Um, and that's on a shareholder by shareholder basis. So I mean, if you had multiple shareholders, it's not just for one person, or it doesn't, cap out and you have to decide how to share it. It's at the individual shareholder level where this benefit gets taken. And so, how does a company, or how do shares qualify? So the shareholder has to receive initially issued shares. So if I'm buying stock of a C corp from another person, like, that's not going to qualify. So again, this is where structuring comes into place. Like, do we tuck it under a new C corp we set up, where that new C corp does issue initially, where shareholders can receive initially issued shares? So there's definitely structure things that come into play when you're buying a business. And then what qualifies and what doesn't. You have to hold the shares for at least 5 years. There are opportunities for certain rollover, where if you are exiting before 5 years, there's some rollover potential, but again, more complex than we have time for today. Um, you look at it as there's certain disqualified businesses. So banks, insurance companies, uh, heavy real estate, um, and then service companies, uh, are certain service companies are specifically identified. Law firms, accounting firms, I think architectural firms, certain things just don't qualify. And then there's a very broad overarching statement that basically service firms where people are your main asset. Well, that's really like law firms and accounting firms, but it doesn't exclude all service firms. Oh, and medical service businesses don't qualify. That's really doctor patient, but there's a lot of businesses on the periphery of medicine, um, where they have qualified, and there's private letter rulings out there. So it has to be not a disqualified business. You got to hold 5 years. You have to use 80% of your assets in the qualified trader business. Any real estate that's not used in the qualified trader business, it can't exceed 10% of your assets. I mean, there's a whole host that, again, like I said, I can't do it full justice, but just want to make the point that it is a complex analysis. You have to be pretty certain that your business can qualify, and you have to be pretty sure that you intend to hold for 5 years. But if you meet all the requirements and you hold for 5 years, I mean, the benefits are pretty substantial, which is why the IRS creates some hoops for people to jump through. But I've had clients that have successfully gone through and exited it, had an exit with QSBS, and so I've written a number of memos analyzing that, and so they can be certain that there's you know a likelihood that they're going to successfully get QSBS treatment.
Yeah, no, thank you for fitting in years of tax law in 30 minutes. It's not the easiest thing, but it's definitely something to be aware of. Again, you might not qualify, but if you do, it's certainly something to look at, especially if you're taking on outside investors. I would say they really obviously appreciate the tax benefits of that. So, as for
Yeah.
yourself, definitely something to look at. It's just if you qualify or not. So I think
No, as you
we'll go ahead.
no, I was gonna say, as you mentioned in venture, it comes up often, right? Because they're in earlier stages, and one other important headline, requirement is there has to be under $50 million in assets at the time the stock is issued. So when you look at 1202, you look at issuance by issuance. So it could be that, in a venture context, right? Like the pre-seed C and A rounds qualify, but then you get into B, and all of a sudden the raises themselves are over 50 million, and those further issuances don't qualify. But just because, subsequent issuances don't qualify, it doesn't go back and disqualify the previous issuances. So it's important to, you know, when you are exiting, really have someone qualified to do the analysis and feel confident that you have a strong position to take. And again, the analysis is partially at the company and partially at the shareholder. This is a position taking on the shareholder's return when they sell the shares, but they obviously need information from the company in order to be able to take that position. So I've also done a lot of projects where, on behalf of the company, we'll do the full analysis and then draft either an LP or a shareholder level, whichever, because you can hold QSBS shares through a partnership. So you can hold it through a flow through. So if you just say had a parent like LLC Holdco that held C Corp shares, just because you hold your interest in a partnership, you can still get QSBS treatment. And again, so long as you held your partnership interest before the partnership received the qualified shares. If you come into the partnership after all the shares have been received, then you wouldn't get QSBS treatment. So again, this is all in the planning and the structuring and the timing, and something we heavily focus on at Albrecht Law.
Yeah, I think that's, it's important too. I think, to be fair, Venture's a bad example there because those early rounds, it's almost a no-brainer. Whereas when you're doing an acquisition, there's a ton of other considerations, whether it's legal or tax, to your point, that play into it with the seller and the buyer. So, if you can get it, it's something that you should definitely look at. But if you can't during your deal, it's definitely not. You know, it happens that you don't get that qualification too. It really just depends on your deal. It's hard to make a bucket assumption about everything. So I think that kind of covers all the in-depth terminology stuff. I think to finish, would just like to go through maybe some things that you see searchers fail on. I think you've probably had a few of those phone calls of, oh no, I didn't know this was going to happen to me. Maybe 24 months into a deal or 12 months into a deal after they close, and trying to get services that you can't no longer fix, but also maybe you have some things that you've saved searchers from going into it. But what are items that you see most common folks don't think about from a tax perspective, where they get a tax bill in that first year that they weren't thinking about, that really hurts their cash flow numbers, or puts them in a bad spot?
Yeah, no, great question. And I think the biggest surprises can come out of not doing tax diligence. Now, I think there's always a primary focus on QOV, and I could argue probably for good reason. It's important to know, you're buying, the earnings are the earnings, the EBITDA is supportable, that the number you're paying is something you're going to be able to service the debt on, and ultimately feel comfortable buying the business. That's very important. But I would argue that tax diligence is also incredibly important for some of the issues you just mentioned. It can really, if you go in and you buy the business, you don't do tax diligence, and just say it's direct to consumer, they're selling a lot online, and since there's a Supreme Court case, I think it was in 2018, they call it Wayfair because it dealt with that online retailer, but now it's much easier for states, and most states have uniformly adopted an economic nexus for sales tax. You don't need physical presence anymore. Just by selling online, generally it's over $100,000 of sales in a particular state. Now all of a sudden you have nexus, and you should be filing sales tax. And those numbers can go up quickly. If you have a successful business, 100,000 is not a super high threshold. So if a company hasn't been on top of this, and people are really primarily focused on income taxes, there's not always a focus, management. They don't have a big team of 10 people doing taxes. I mean, everyone's stretched thin and focused on growing revenue, cutting costs, and having an efficient business and growing sales. But sales tax can really balloon to be a big issue. And if the seller hasn't been filing and a state contacts you, they can go back to the beginning of time. If you haven't filed a return, the statute of limitations doesn't start. So I've seen sales tax issues become, quite large issues, and in diligence, if you discover it beforehand, first of all, you can either work it into the numbers as a purchase price adjustment if it rises to that level, get an escrow set aside, or ensure that you're indemnified if anything comes up, and you believe the seller can stand behind the indemnity. but there's also a way to clean it up going forward. I think all states, but I'll say most states have a VDA, a voluntary disclosure agreement process, where you can go in, say, hey, listen, we screwed up. We want to come clean. We want to come in, be a filer going forward. And they generally will look back 3 years. They'll abate some penalties and interest instead of going back to the beginning of time with heavy penalties and interest. So again, it's a manageable process if you know about it. But if you don't know about it, if a state contacts you, I mean, it can be a big cash flow hit and something you wouldn't expect. And then again, like if you're relying on indemnities, you don't have escrow, you didn't get a purchase price adjustment. If the seller doesn't want to just write you a check and you have to litigate, I mean, that's another very large expense. And so if there's $100,000 issue and litigation fees are 200 or 300 or 400 or more thousand, sometimes you just have to give up from a business standpoint and say like, well, we should have been protected and we weren't. And so I would say doing diligence really helps avoid all of these
Now that we've
issues.
Yeah, now that we've scared everyone who's listening, I'd love to, wrap it there. I think, lot to take in, and tax is very complicated. So really appreciate you taking the time today. I think to close, I'd just love to hear more, about what kind of clients you're looking for your firm and what you serve in the market. And then we can wrap from there.
Sure. So my experience, the largest deal I worked on is 40 billion. Have done a few in the teens, quite a number in the single digit billions. But then also, I've done a lot in the, even for $1 million deal, there's certain things we can do. I think from a cost benefit analysis that it's very helpful. But generally, say like 3 to 5 to 100 million, that's there's just like everything, structuring, diligence, all the services we talked about. But yeah, I've done a lot of work with independent sponsors, with searchers. I mean, that's our primary clientele at Albrecht Law, and I would say, yeah, anywhere 3 to 5 million up to, in the 100 million plus range is the deal size and what Ellie and I have extensive um, background and experience working on.
Great. Thank you so much for joining us today. That's Albrecht Law, everyone. This is Josh Siegel, and feel free to reach out to him, and we'll get this posted. But thank you so much, and talk to you soon.
Yeah, thank you so much, Dennis, for having me, and happy to be here. Thank you.